Okay, so chapter 3 is starting the bookkeeping cycle, but today it's very, very important that we focus on analysis. If you analyze things well, the rest of this is going to fall into place. So today's lesson is strictly on objective 1 in chapter 3. Learning objective 1 looks at analyzing what's called business transactions and its effect on the accounting equation. So accounting, as you know, is quite a system. It collects information, it processes data, and it communicates that data through financial statements and other financial information for managers, creditors, investors, others for decision-making purposes. So that's the broad look at things. Chapter 3, in this particular illustration, chapter 3 is actually the first 4 arrows. We're going to be learning all of these in chapter 3. Again, we're starting and focusing in on the first part today. The rest will happen. All the other arrows are in chapter 4. It's actually the concluding end of the bookkeeping cycle. So this begins the cycle, chapter 4 ends the cycle. And then, of course, there's a large project on all of it at the end of this particular class for a final project. Okay. We're going to be doing this manually and through the use of the Wiley software, but in actuality, all of these records are kept and computerized quite well. There's a lot of accounting software that is available. Small businesses might gravitate toward a QuickBooks or something like this, but oftentimes larger organizations will have their own accounting software customized. So let's take a look at what we're doing today. So we're focusing on analyzing a transaction. A transaction is an economic event that affects the financial condition of the company as it happened. Okay, so we have to determine then what is an economic event from something that happens that's not an economic event. And the key thing you need to remember is if it changed the financial condition of the company as it happened, it's an economic event, which means it's a transaction. Only transactions get recorded in the accounting records, okay? Events that look like financial transactions don't always get recorded. For example, I could hire you, say I'm looking for a bookkeeper, and I could hire you right after this class for a salary of $40,000 as a bookkeeper. And you'll say, great, let's do it. Well, that sounds like an economic event because I promised you $40,000 for your work with me. But in fact, it's not an economic event today because I don't give you the $40,000 up front and say, okay, now you owe me all this work. You have to work for it before you get paid. So it sounded like an economic event because money was tossed out, was talked about. But in fact, it's not a transaction. It's not an economic event because it didn't impact the company right away. It will impact the company when I pay you. But it doesn't affect the company, the fact that I hired you for a particular salary, okay? Because again, no one gets paid up front. If I wrote you a check for 40 grand, I wouldn't see you on Monday. All right, you'd probably be in a nice warm place on the beach somewhere, potentially. I mean, maybe somebody would show up, but I'm just saying, you know, in essence, that's not how anyone gets paid. I don't think anyone has gotten paid up front, right? And then you owe that to your employer. You have to work for us first, and then they pay you. So again, not all activities that happen in a business are transactions, are economic events, because not all activities change the financial status of the company as it's happening. That's the important thing. It's Accounting and bookkeeping is sort of in the now. We're not looking in the future. We're looking right now. Did what happened right now change the financial condition of the company? If so, right now, we have to do bookkeeping. If not, if it's going to happen at a later time, we don't have to do anything right now. It looks like we will when we get to that bridge and we'll cross it. So I think it's important to not project into the future certain things that might happen. When we're looking at analyzing a transaction, it's immediate. Did it change the economic and financial condition of the company while it happened or as it happened? We're going to need to take a broader look at our accounting equation, at our financial equation. We know that assets equals liabilities of stockholders' equity. But as you'll see in a moment, stockholders' equity is quite large because even though it looks like it just has two accounts, you know about common stock, you know about retained earnings. Retained earnings is actually quite big because if you want to look deeper into retained earnings, the income statement and the retained earnings statement fold into retained earnings. So actually retained earnings encompasses your income statement and your retained earnings statement as well. So anything that affects the income statement or the retained earnings statement is ultimately going to affect retained earnings. And we're going to have to take a broader look at that today because in order for you to understand how to look at transactions, you have to see retained earnings in a bigger light. And just understand too that transactions always have what we call a dual effect. They will always be, and I just look at it this way, there's always going to be at least two accounts. Now that's what I said, the word account. Which is what I said, you have to know the accounts. There's going to be at least two accounts that are affected by every transaction, okay? So if a transaction happened, again, you're thinking two accounts, at least two accounts, are affected by what just happened. Part of the analysis is figuring out what two accounts were affected, okay? And so that's going to be part of our trip today. And here we go. First of all, let's see if any of these events are indeed transactions. So in order to be a transaction, it's an event that changed the financial position of the company as it was happening or after it happened, right? So let's take a look at the very first event here. It says we purchased a computer. We will look at that as purchasing computer equipment, right? They say yes, it is a financial, it is a transaction because it did change the financial position of the company. And even though this is an incomplete sentence here, we know that when we purchase any equipment, right, we have more equipment, which means our assets have changed, right, after we purchase it. The question that's missing here is how did we purchase it, right? So if we purchase it with cash, say we bought computer equipment with cash, open question, what two accounts are affected if I say we bought computer equipment for cash? What two accounts are affected if we purchase the computer equipment for cash?
Revenue and expense?
No, we didn't sell anything. Remember, revenue is selling.
Oh, right, not revenue.
Revenue is
but
selling
expense.
products and services, right? I mean, that's all. That's the only thing revenue is. When we sell products or services, that's revenue. We're not selling anything. We bought a computer for cash. It's not an expense because a computer.
Cash. So it would be assets.
Current assets. Computer equipment is going to last a long time, right? So computer equipment is going to be part of our property, plant, and equipment. So we are going to do, and you're right. If we bought it for cash, cash is affected, and equipment is affected. Those two accounts are affected. Even if you said revenue and expenses before, I would say no because that's not. Those are types of accounts. I need to know specific account names, right? So even when we get to those transactions, I need to know specifically what accounts, because revenue is not an account. Service revenue is an account. Revenue is a type of account. Expenses are not accounts, but rent expense is, right? That's a specific account. I need to know the specific account. So again, you have to start thinking in this part of the chapter, what specific accounts have been affected by the transaction. And again, at least two are going to be affected. So yes, if we bought the computer with cash, we have more equipment, right? Because equipment is affected, we have more of it. And we have less cash. If we bought it for cash, we had to give that cash away, so we have less cash. Everyone understand that? Let me throw another one at you. What if we, as a business, buy this computer from another business and they simply give us, an invoice to pay later? So we got the computer, we bought the computer on account, which means we bought the computer and they gave us a bill to pay them in 30 days. We have to pay for that computer in 30 days. So we bought it on account. What two accounts are affected if we purchase the computer on account? I need specific accounts.
Accounts payable and equipment.
Okay, so we bought more equipment, so we definitely have equipment account is affected. But now we have a bill that we need to pay in 30 days. And as you know, that's an accounts payable. So accounts payable is affected, right? Because now we have a bill to pay in 30 days. So, so again, that's something that you have to really think about. When an event occurs, did the financial position of the company change? If the answer is yes, which in this case it did right away, we bought a computer, we have it. So what accounts are affected? Well, if we bought it for cash, we have more equipment, but we have less cash. Right? If you paid cash, you have less cash, but you have more equipment. If you bought it on account, you got more equipment, but now you have more bills to pay, right? More accounts payable. That's the analysis. That's the piece we're going to be looking at. Look at the middle event here. We discussed guided trip options with a customer. Now, customers come in to stores or call about information all the time. What do you do for this? What do you do for that? How much does this cost? How much does that cost? We might talk about products and services and money and how much the cost is. Does that make it a transaction that we're talking about it? No. Because talking about it doesn't mean we've collected any money or we have a new client. We're just talking. So discussing guided trip options with customers is something that happens in business all the time, right? Discussing our products and services and what they cost happens all the time. It's not a transaction because even if the customer looks promising, okay, I'll call you next week or whatever. Nothing happened. We didn't sell anything to them and they didn't give us anything. So the financial condition of the company didn't change at all. Even with a promise, okay, I'll see you, I'll be back next week. Okay, that's a promise. We'll deal with the accounting next week if it happens. See, we're very focused on what happened right now. And there, nothing happened. We just talked, okay? Let me change this a little bit. This is based on Sierra Corporation, which does tours of the Sierra Nevada. Let's say Eva was talking to a guided tour person about a trip, and she said, okay, I'll take the next tour, and the next tour is just about to leave. She buys a ticket right there on the spot, and she gets in line for the tour. Is that a transaction? Again, Eva is talking about the tour, decides to buy the tour. She buys a ticket right there, and she's standing in line waiting to get on the tour. Is that a transaction?
Yes, because she used her money to get something.
Right. So we sold a tour. Right? We sold a tour. She is getting a tour, and we just got her money. Okay. So what two accounts? Let's say she paid cash. And we sold her a tour. So what two accounts specifically now are affected by Eva purchasing a tour for cash? What two accounts? I need a lot of people to get involved here because I need you all to learn. I just got a chat thing here. Accounts, no, I mean, she paid cash. So I'm not waiting to receive anything. Remember, accounts receivable is I'm waiting to receive money for work I've already done. She's already paid me the cash. I'm not waiting to receive anything. She gave me the cash already. So what two accounts are affected if I sell her a tour for cash?
Cash.
Cash, thank you. We just got cash, so we have more cash. Right, okay, that's one account. Remember, dual effect.
And
There's another one.
unearned sales revenue.
Sales
All right,
revenue.
so that's going to be, because we give tours, that's going to be service revenue.
We
Remember,
get less.
sales revenue is about selling a product.
We get
If
less.
if I sold her a T-shirt about a tour, that's a product. That's sales revenue. But I'm selling her an actual tour work, right? I'm going to take her for a hike, and so that is service revenue because that's a service, right? So service revenue is affected and cash is affected by that. We understanding a little bit? Let's keep going. Let's say it's still, I'm sorry to pick on you, Eva. You're just the first one in line in my little list of folks who have their cameras on. Eva is talking about this trip with me, and she goes, look, I'd love to go on a trip, but I can't this week. I can next week. So she gives me cash for a ticket for next week. She's going to be on a tour next week. Is that a transaction?
Yes.
Yeah, damn, it sure is. Yes, yes, yes. You can bet your bottom dollar. Now, question. What two accounts are affected by that transaction? Remember, she gave me cash for a tour next week. She can't do the tour today, but she can do the one next week.
Same, cash and unearned service revenue.
If it's service revenue, I've already done the work.
Unearned.
Remember, revenue is about I've earned it. So if I've
So
earned it,
accounts
I'm already
liability?
giving her the tour, or I've already given her the tour.
Notes payable or
Accounts-
accounts payable.
Accounts payable?
Unearned service revenue.
Okay, so Nick is right. Would that be a liability? Yes, it would be. Remember, a note, because I heard the word note. A note is a loan from a bank or a loan, and this is not a loan. She just paid for a tour next week. So I got cash. So cash is going. I have more cash because she just gave me a bunch of cash. But now I owe her a tour next week, which is unearned service revenue. It's a liability. Remember, when you owe the customer work because they paid up front, it's unearned service revenue. And so, so those two accounts are going to be affected. Drugs are bad. Okay, so one other one. Eva, I'm sorry, you're still here looking at tours. Okay. And Eva's like, okay, I can go on the tour that's leaving right now, but I can't pay you today. I have to pay you later. And I say, okay, go on the tour. We'll give you the tour today, and here's a bill. You pay me later. Is that a transaction?
Yes.
Yes, it is. What two accounts are affected by that transaction?
Cash and unearned revenue.
No, that's the other one. Nick is saying accounts receivable. Now look what happened here. I sold her a tour. She's getting a tour right now, but she's going to pay me later. I'm giving her a bill. So Nick is absolutely right. He's just writing everyone. It's accounts receivable. Remember, when I'm waiting to receive money, it's because I've already done work for someone and they need to pay me the cash. Remember, accounts receivable is waiting for cash. Why are you waiting for cash? Because you've already done the work for these folks. You've already done the work for these folks. So in this case, for Eva's case, I would have more accounts receivable because I'm giving her a tour and I'm waiting to receive her cash for the tour. And I'm giving her a tour. I sold her a tour. That's service revenue. I'm doing the work for her right now, right? That's service revenue. Remember, service revenue is about work that you have done, okay? You can't be wrong if you write down every, well, no, you only have, every transaction only has one record in accounting. When something happens, the accounting has to be done that reflects exactly what happened. Remember, that's faithful representation from the little talk we had about GAAP in chapter 2. It has to be relevant and it has to be faithful. And so it has to be free from error. So when something happens, you have to analyze it properly and mark it down, which is why we're going through this today. This analysis is really the key to understanding what's going on in accounting. This is something that and I'm glad I'm doing this on a Thursday with you when you have the weekend to study this stuff, because this is critical to your success in the class. The analysis is the real key in understanding these things. And it takes practice. Don't kick yourself in the butt if you're making mistakes. This is all new. It's like riding a bike when you were very, very young. You know, you're wobbly, maybe even fall down. No problem. Happens. Normal. Yes, Clark.
When I had my own business, I didn't like to do accounting. So I pretty much did it once a year. But I didn't realize at the time what I was doing per se, but I do now. I had a manila envelope that basically each one was one of these accounts.
Awesome.
So when it happened or whatever, I drop it in that manila envelope.
That's perfect. That's
once a year.
That's a good way of doing it as well, because you can always have a record of what's happened, assuming there's dates on all those things and so forth. You can actually track what happened in every month and every quarter of the year.
Yep.
And a lot of people it's not uncommon to hire bookkeeping services for small businesses. So that would have been an option as well. Maybe you already had a good accountant that you could drop that stuff off with, and they put all together and spit out.
Actually, I would go to the accountant with my stack of manila envelopes. They would ask me a question and I'd flip through them. And by that time, I'd done a calculation on the front. They'd ask, I'd look at that one, tell them the number. They'd ask, I'd look at that one, tell them the number.
Perfect. Yep, that works. A lot of small businesses have skills in a lot of areas, but not bookkeeping. And so obviously they need to they need to keep very, very good records, like you were doing, or they need to hire, and oftentimes they hire an accounting firm or a bookkeeping firm to compile all that type of stuff, so they have records of that. QuickBooks is really designed for the small businesses to make it easier to keep track of those things. You can even scan the receipts, and the QuickBooks analyzes it and puts it in the accounts for you automatically. It's pretty amazing what the software is able to do for folks to help them keep the record straight.
Yeah, also, charge cards and bank accounts will also separate out all the receipts for you and add them up.
Only if you keep it separate from your personal accounts.
Yeah, you're supposed to keep things separate. Yeah, Jeanette's got a point. All right, let me move on, because we have a lot to do today, if we don't mind here. So here, bookkeeping. Trevor is right. We're going to have. There is a pretty good demand. There's always a need for bookkeeping and accounting staff everywhere. It's a very important job. So I would agree with that. Let's look at the last event here. We paid rent. Now, you might not know, or maybe you do already know, most businesses rent their space. Most businesses do not own the buildings that they're in. There are quite a few that do. Walmart, McDonald's, they like to own, Wendy's, they like to own their own buildings. But the vast majority of businesses that you see are renting. You go to the mall, it's 100% rent. Every store in there is renting space from the property managers of the mall, whoever owns the mall. And that's true for offices. In many downtown office buildings, They just put up, right, most recently, you know, every time they put up a skyscraper with a bunch of office space, that's all rented space. It's all leased space. So a lot of businesses are paying rent every month to some landlords. As a matter of fact, you keep hearing that in the news in New York City about since COVID has hit, a lot of small businesses and restaurants can't afford the rent, and they're asking, you know, landlords to be to help work through that with them. So I think that that's rent expense is a okay. Yes. Rent expense is a common expense on the books of a lot of businesses because a lot of businesses rent their space. So is paying rent a transaction? Yes, it is. And I don't know about you, but landlords do not want to get paid in anything other than cash, right? Which means I'm writing a check to them, that's cash. Or I'm, you know, doing that. That's so what two accounts are affected by this transaction? I need you to be specific. Open question out there. If someone knew, would be great, because at least I know who's out there. Oh, I got a little ding here for a chat. Let's see what it says here. Okay, yes, that's true, Trevor, but I need to know the accounts. I need to know the accounts that are affected by this transaction.
Cash and rent expense.
Okay, so the two accounts that are affected, like I said, we pay, the overwhelming amount of expenses are paid in cash right up front. And so rent is going to be paid in cash. So we have less cash. Well, every time we pay rent, we have less cash. But we also have rent expense. And rent expense, right, expenses come out of profit, right? When you look at the income statement that shows you your profit, what's standing in the way of revenue and the profit? Well, all those expenses. In essence, expenses take away from the profits of the company. And so more expenses means less profits for the company, which means less retained earnings in essence. And so in this case, that's what's going to happen here. No, we're talking specifically about accounting in this particular class. All right, so let's keep going on here. Does everyone sort of understand? This is just, I'm just throwing this stuff at you early. The whole chapter is about this. I'm just starting you thinking early because this is the type of thinking we need to do here. And so that's really important here. I'm looking like a bobblehead when I do this. Yeah, this type of thinking we're going to do here. Yeah, Mr. Bobblehead, accounting teachers right here. Okay, so here we go. We have to think of, as I mentioned, a little broader perspective of the accounting equation, which we all know is assets equals liabilities and stockholders' equity. But like I had mentioned earlier, we really have to expand our knowledge of stockholders' equity because stockholders' equity really is bigger than we think. Common stock is common stock, but retained earnings is very unique because we have, in essence, the income statement, right? Revenue minus expenses is the income statement, right? Revenue minus expenses gives us net income, right? Net income. Net income goes on the retained earnings statement. We take away dividends. After we take away dividends, we have our ending balance and retained earnings. Retained earnings, in essence, absorbs all the information from the income statement and the retained earnings statement and puts it on the balance sheet. Okay, so remember, retained earnings is the profits, right? The word earnings is the same as profit or net income, right? Retained means the amount that has been retained, kept in the company. It benefits stockholders' equity. It benefits stockholders' equity, right? Because owners, it's the owners that own the profit of the company. So in essence, if you want to look at this a little bit differently, every time there, revenue is, in essence, the source of the profits of the company. Look at your income statement. Revenue minus expenses. If there's anything left over, it's a profit. Well, what's going to be left over is all the extra revenue. that wasn't used to cover the expenses. So in essence, revenue is the source of the profits for corporations, for all businesses. So in essence, the more revenue the company makes, the more retained earnings or the more profits it's likely to have. Revenue has the same impact of increasing retained earnings. That's not true for expenses. What do we do with expenses? Well, as you know, on the income statement, we take away those expenses from the revenue to get that difference, that net income. So in essence, the more and more expenses we have, the less and less profit we have, right? The less and less earnings. So expenses have an effect of taking away from the profit of the company. In other words, it shrinks retained earnings. When we get to net income and we use part of it to send it out of the company in the form of a dividend, that's also reducing or shrinking the amount of retained earnings. And so in essence, every time we pay a dividend, we shrink retained earnings. We have less retained earnings. So to expand this, the income statement, every time there's revenue, we look at it as more earnings. Every time there's more expenses, we look at it as less earnings. Every time we pay a dividend, we look at it as less earnings. And you can just look at the financial statements, the income statement and the retained earnings statement, to understand why we talk about more or less, or increases in profitability, decreases in profitability. So remember that. That's very, very important. Again, every time there's a rent expense, right, expenses are taken away from the profits of the company. So in essence, the more expenses there are, the less retained earnings there are. So this is how we have to start thinking when we're analyzing. All right, so this is important, and I think it's a really good thing for you to do is to have references to the book here, and I will put this up as well on Wiley for your reading. But if you have your book, this starts on page 94 and goes all the way to page 99, and it's a very, very good, it's very good to review this and understand what's happening. Now here we're looking at Sierra Corporation, and I just want to explain what's this. So Sierra Corporation, you can see assets equals liabilities and stockholders' equity, and then they have given us specific accounts. So there are 4 asset accounts that are listed: cash, supplies, prepaid insurance, and equipment. There are 3 liability accounts that are listed: notes payable, accounts payable, unearned service revenue. And stockholders' equity is expanded, as we've talked about, common stock, and then retained earnings is expanded for revenues, expenses, and dividends. Now, in this particular very first event, this is how corporations begin, right? Investors put cash in the company. They get shares of common stock. They get equity. And so when on October the 1st, investors put $10,000 of cash in Sierra Corporation in exchange for $10,000 of common stock, this was a transaction. The economic financial position of the company changed with this event. How did it change? Well, we had more cash because the owners put cash into the company. So the company has more cash. But the company now has to record that it has more owners, more common stock, $10,000 worth. And so as you see, what this analysis is doing, and all this is analysis, this is not accounting. This is strictly analysis. We had to, remember, it's a dual effect. We had to identify the accounts that are affected by every event. So for this event, 2 accounts are affected: cash and common stock. How are they affected? The company has more cash. The little plus 10,000 simply is, that's not accounting. That's just telling us, analysis-wise, we have more cash, $10,000 more in cash. And a common stock here we have, again, this is a plus 10,000, but this is not accounting, this is analysis. All this is telling us is, okay, we have $10,000 more of common stock, right? This represents the owner's investment in the company. shares of ownership for cash. More cash, more shares of ownership. Are we okay with this so far? That's on page 94. Let's move on. The second event that happened to Sierra Corporation also happened on October the 1st. So again, it's understandable to know that transactions are done in order. And so what you'll see here is they'll be done by date, chronologically. So on October the 1st, Sierra Corporation borrowed $5,000 from Castle Bank. They signed a 3-month, 12%, $5,000 note. So again, just to remember about a note payable, a note is a loan. In this case, how notes payable work. You get the $5,000 up front, okay? You don't pay the loan back or the interest on the loan until it's due. It's not due until 3 months from October the 1st. So it looks like January 1st. That's when we pay it back with interest. In the meantime, the only thing that happened here is we just got a loan. So when you get a loan, and I don't know how many of you have been approved for a loan, you get the cash. Get the cash up front. So here we have cash that's affected. How is it affected? We have $5,000 more of cash. But now we have a loan to pay back. So notes payable is affected. How is it affected? We have $5,000 more of notes to pay back. So more cash happened, more notes payable happened with this event. Are we okay so far? Just looking for, we okay?
Yep.
Thumbs up on this? Okay. So the good news is these events tend to repeat, so they're good to study. All right, the very next event, event number 3, happened on the 2nd of October. And here, Sierra Corporation, they bought equipment by paying $5,000 cash to this company, Superior Equipment Sales Corporation. Okay, wonderful. How superior for you. So you thought about this. Did the financial condition of the company change? Yeah, they just bought equipment for cash. So the two accounts that are affected here, equipment is affected. How is it affected? We have $5,000 more of equipment. But cash is also affected. Remember, it's a dual effect. At least 2 accounts are going to be affected at all times. Every transaction, 2 accounts, never just one. We have $5,000 less in cash. See, in this case, it's showing us we have less cash, but we have more equipment. The fourth event, now here I'm on the bottom, page 95, if you have your book with you, also happened on October the 2nd. And it looks like Sierra Corporation received a $1,200 cash advance from a client. Now, a cash advance means a client is paying upfront for services to be done later on, okay? So in this case, our Knox is paying cash and is expecting to get $1,200 worth of tours in the future. So what just happened here? Well, the company had just got a bunch of cash. So certainly cash is affected. $1,200 more of cash just happened to the company. But now the company owes this guy a whole bunch of tours. That's what unearned service revenue is, right? The fact that we owe clients work for what they paid for. And so that is showing here as more unearned service revenue that we just took in. In other words, we owe the client. Event number 5, now I'm moving on to page 96 in your book here, happened on the 3rd of October. And it looks like Sierra Corporation received $10,000 cash from this company for guided services performed. I want you to notice that word. Performed means past tense. The work has been done. If you've already done the work, you've earned the revenue. So this $10,000 certainly affects cash because we were just shown we got more cash. So we certainly have more cash, but we performed work. We already provided this tour. That's what revenue is. So we have more revenue. Has more revenue. Revenue is the source of the profit for the company. In other words, it's the sources for retained earnings. So more revenue is the same as, in essence, more retained earnings for the company. Event number 6, and we moved on to the bottom of page 96. Also happened on the 3rd of October, and it looks like they paid rent, $900 for rent. So again, when you pay rent, you're going to be paying in cash. So in this case, if you're paying in cash, you have less cash. So it shows here we have less cash for $900. But as you know, paying rent is an expense, rent expense specifically. And every time we pay an expense, in essence, we have less profits, less earnings in the company. So again, more expenses simply means less retained earnings, less profits. Event number 7 happened on October the 4th. Again, you'll see this in chronological order. They paid $600 for an insurance policy that'll expire next year. So when a company buys insurance, that insurance becomes an asset for the company. So here they have more prepaid insurance. Okay, they're going to use that asset up within a year. It's a current asset, right? But they had to pay cash for that, so they had less cash, but more insurance. Event number 8, Ocho, one of my favorite numbers, Ocho. If I had a puppy, I would name him Ocho. I'd say, come here, Ocho. Okay, that's just me. In my head, I don't have a dog, so it's just a dream. Okay, so that also happened on the 5th of October here. They bought supplies on account. This wonderful little term here, on account, means that we were able to buy it and we're going to pay later, right? So when you buy something on account, you bought it, but the business allowed you to give you an invoice, they allow you to pay it later. So we certainly have more supplies. So we bought supplies, which means we have more supplies. But this means we have more bills to pay. And that means an accounts payable. A general bill is an accounts payable. Okay. Event number 9 happened on October the 9th. Sierra Corporation hired 4 new employees. I don't care whether they promised those employees $1 million a year. When you hire someone, you don't pay them up front. You say, okay, you'll start on Monday, I'll see you then. Even when they show up on Monday, you're not doling out the cash, right? They got to work first. You know how it is. You've all been worked. You've all worked at some point in your life. You go to work, you have to work first, then you put in your time card, then they pay you on the next payday. So it's not a transaction until they pay you. Okay, so hiring people, not a transaction, not a transaction. No accounting is done. Event number 10, Sierra Corporation on the 20th of October, they paid a $500 dividend to their owners. Now remember, dividends are on the retained earnings statement, and you see that they are deducted from retained earnings, right? Less retained earnings. So in other words, the more dividends there are, the less retained earnings there are, because we take them away on the retained earnings statement. And of course, we pay those dividends in cash. So we have less cash and less retained earnings because dividends shrink retained earnings. Event number 11, those employees have worked and now they've earned $4,000 in salaries and it's payday. It's payday. So on payday, we certainly will pay them. So what happened here? Well, our employees do not work for anything other than cash as well. So we certainly will pay them in cash, $4,000 less in cash. But again, when we pay employees, that is a salaries and wages expense. And again, the more expenses that we have, the less retained earnings that we have. Okay, so this is basically, I'm not going to do that. This is basically the transaction analysis that is such an important part of this chapter. That's why I only do it as a sole objective. I don't mix it up with other parts of the chapter. We're only going to do this once. After we do this once, you're used to the analysis. You'll never see this again. We're going to actually be doing accounting. This is strictly analysis. Is it a transaction? Which means it's an economic event and the financial condition of the company changed when it happened. If so, what two accounts are affected by that event? And you need to name the specific accounts. Okay, can't say assets and liabilities because those are types of accounts. They're not accounts, right? Cash is an account, right? Notes payable is an account. So when I say you have to name the accounts, I'm saying you really have to name the accounts. So if that means you have to sit and think and go through a few things, that's fine. That's part of what this chapter is about. This part of the chapter is about. Sit down and thinking things through. But just to know, at least two accounts, right now in this chapter, only two accounts are affected. But as transactions become a little bit more advanced, you'll see that sometimes more than two accounts are affected. Questions? Staring contest. Who blinks? No. Okay, so basically speaking, this is your, okay, Anthony, I believe you. This is your work this weekend. And I'm going to stop the recording.